Massive structural shifts in large systems often begin with tiny, barely noticeable maneuvers. A multi-billion-dollar utility conglomerate changing direction starts with a small adjustment to test the resistance of the water. Evidence of such a move appears in a formal disclosure filed by Torrent Power on March 27, 2026. This document was submitted under SEBI Regulation 30. This compliance rule mandates that publicly traded companies immediately disclose material events to the stock exchange, ensuring the market stays informed of any significant internal changes. The subject of this specific disclosure is the acquisition of 100% of the equity in an entity named Torrent 47 Private Limited, or TU47. The target entity's profile contains an immediate anomaly. In the required disclosure table, TU47's turnover is recorded as nil. It is a company with zero revenue. The financial scale of the transaction is equally small. Torrent Power acquired 50,000 equity shares for a total cash consideration of just 5 lakh rupees. A major utility conglomerate formally broadcasting the acquisition of a zero-revenue asset for a value that equates to a corporate rounding error suggests that this filing is a structural blueprint rather than a financial play. The origins of TU47 date back to its incorporation in Gujarat on March 19, 2025. In its current state, TU47 is a shell entity, a clean, inactive corporate vessel with no operational history or existing liabilities. The share structure reflects this. The 50,000 shares were acquired at a face value of exactly 10 rupees each. Trading at exact face value indicates that there is no underlying intellectual property, established brand value, or active market premium attached to the entity. This differs from a traditional M&A acquisition, where a buyer pays a premium to secure existing market share, technology, or established revenue streams. If there is no active business to acquire, the question becomes, why does a conglomerate need an empty corporate vessel? By acquiring a clean shell, Torrent Power secures a legally isolated container for a specific future maneuver. The identity of the seller clarifies the intent behind this transfer. The document lists the seller as Torrent Green Energy Private Limited. This seller is a wholly owned subsidiary of the parent company, Torrent Power. The initial corporate hierarchy places Torrent Power at the top. Beneath it is the Green Energy subsidiary, which in turn holds the shell entity, TU47. Because the buyer and seller share the same parent, this move is classified as a related party transaction. Regulators monitor these moves closely to prevent parent companies from hiding debt or siphoning capital between subsidiaries. To maintain transparency, these internal moves must satisfy the arm's-length pricing requirement, meaning the price must reflect what a third party would pay on the open market. The 5 lakh price tag satisfies this rule precisely. It represents the uninflated administrative cost of the shell's registered capital. The transaction mechanics then move TU47 laterally across the ledger. It detaches from the Green Energy subsidiary and attaches directly to the parent. This results in TU47 becoming a direct 100% equity-held subsidiary of the parent company, completely severed from the Green Energy arm. This lateral move was executed entirely in cash. This entire bureaucratic process was required just to shift an empty box from one side of the corporate ledger to the other. The 5 lakh transaction represents the administrative toll required by regulators to reconfigure the parent company's corporate architecture. The motive for this reconfiguration is found in the Objects and Effects section of the SEBI disclosure. Torrent Power explicitly states its primary strategic intent is to acquire large-scale thermal power plants in the near future. The secondary objective is to use this entity to create a separate thermal business vertical. Green energy and thermal power have distinct business profiles. They differ in capital expenditure requirements, regulatory risks, and environmental liabilities. Housing these vastly different asset classes under the same subsidiary mixes high-risk thermal assets with clean energy. This risks cross-contamination, where the financial liabilities or environmental risks of a thermal plant could negatively impact the valuation or financing of the green energy portfolio. To prevent this, the company uses a special purpose vehicle, or SPV. Transforming TU47 into an SPV creates a strict legal and financial firewall between the core business, the green assets, and the new thermal acquisitions. This firewall allows the company to secure specialized debt financing specifically for the thermal SPV without leveraging its clean energy assets. An isolated SPV also makes it simpler to sell or spin off the thermal vertical in the future if market conditions change. A zero-revenue entity provides the perfect blank slate for this high-risk vertical, free from the complications of legacy contracts. Ultimately, the strategic acquisition of TU-47 constructs a blast-proof, secure legal container designed to house heavy, capital-intensive thermal assets. This maneuver explains why regulators enforce public disclosure for a transaction that doesn't immediately impact the parent company's balance sheet. These rules are designed to reduce information asymmetry in public markets. The internal creation of a new thermal vertical is material to investors, even if the shell company itself is currently worthless. By forcing the disclosure of the intent behind the restructuring, regulators ensure the market knows Torrent Power is preparing a major capital deployment into thermal energy. Seemingly tedious regulatory red tape acts as an early warning system, forcing companies to broadcast strategic pivots months before the actual assets are purchased. Financial analysis requires isolating structural signals buried within administrative noise. A $5 lakh internal transfer of a zero-revenue shell entity represents a minor corporate chore. Mapping the nodes and understanding the arm's-length pricing shows the foundational legal maneuver required to launch a ring-fenced thermal power strategy. Accurate market intelligence comes from dissecting the architecture of related party transactions. In corporate finance, it is often the transactions with the smallest financial values that reveal a conglomerate's largest structural ambitions.